The Chinese Premier Li Keqiang, China's second most powerful man next to Xi Jinping, this week warned his country's highest lawmaking body that the country will face a more complicated environment and grave risks and challenges. Addressing the National People's Congress on Tuesday, he set the country's economic growth at 6 to 6.5% this year, just a shade lower than the 6.6% it's believed to have achieved in 2018. He also promised lower taxes and fewer burdens on the private sector. So, should the world read this warning by Li Keqiang as an indication of deeper troubles for the Chinese economy, or should one be confident that China can deliver a 6% plus growth this year? And what does a slightly slowing China mean to the world economy? Hello and welcome to this special show, The Dragon Slows. On the show today, we speak to two China experts. First up, Professor Kenneth Rogoff. He's Professor of Public Policy and of Economics at Harvard University, and of course, a well-known expert on the Chinese economy. A little later, we're going to be joined by a chief economist from JP Morgan, Jahangir Aziz, who oversees emerging markets research in that company. But first, let me welcome Professor Rogoff. Thank you very much, sir, for joining me. First up, you've been a little skeptical of the Chinese numbers, GDP numbers. This 6 to 6.5%, you think it's a reliable number?
Well, of course not. I mean, I was laughing when you said the world wonders if China can deliver a 6 to 6.5% number. They're going to deliver a 6 to 6.5% number. It's just not clear that's a real number. They haven't solved the business cycle. Everybody has slowdowns. They're having one. I think it's a very significant one.
Okay. Well, first up, before we get to how slow is really the Chinese economy, how slowly it's going, what are your thoughts on the trade truce itself? While the deadline has been pushed, do you think that China and the United States will get away without raising tariffs too much?
I mean, the bottom line is yes, but there's a lot at stake in terms of intellectual property rights, forced technology transfer. China has become too big not to be a normal player in the international trading system. And I don't know the process this is going to take place. There are going to be a lot of rough patches. I don't know what President Trump wants. I mean, he changes his mind all the time. But there are some very fundamental issues here. If all this is about is closing the trade gap because the Chinese will temporarily promise to buy some U.S. goods, it will be a lot of wasted effort. I hope we see something more than that.
Your thoughts on the Chinese economy itself? Li Keqiang and Xi Jinping have delivered some tax cuts. Their VAT is expected to come down from 16 to 13%. Will all this mean that China will be able to stimulate more consumption and rebalance its economy?
Well, they have not been very successful in rebalancing their economy now for the last decade. They really need to do much more fundamental structural reform. And in 2013, it seemed like that was going to happen, but then it keeps getting put off. We'll see. They're really under a lot of pressure now if they want to keep up growth. But they're fighting something very fundamental, which is they've tried to demonstrate you can have a very centrally controlled market economy. It's an oxymoron. It's a contradiction. And as power becomes more centralized and the Chinese economy aims to become more decentralized, I think something has to give.
Okay.
And I think it will be growth.
Okay, but do you expect something dramatic could happen as early as this year itself? This is the 30th year anniversary of the firing at Tiananmen Square as well. So it's a sensitive year in a sense, 2019. Do you think one should expect social disturbances?
Well, I think they've taken tremendous measures to restrict social disturbances. They really seem to have cracked down using technology, using every possible means. So, no, I don't expect that. But on the other hand, do I expect increased dynamism, increased innovation, increased growth in the private sector? I don't. I think they'll have a very hard time hitting even 5%, much less 6% as a real number. I think the Chinese economy may not have a crash landing. I think it may have a soft landing, but onto a downhill slope. I think the future productivity growth in China is going to be much weaker than it was the last couple decades.
Okay. In that case, what should the global economy be prepared for? We have already seen softer crude prices and even softer, probably, LME metals. Should softer commodity be the order of the day? Because China would not be the kind of consumer it was last decade.
Well, that's absolutely right. It's going to hurt commodities. But it's also, I think, a major factor impacting Europe. Everyone's marking down growth forecasts for Europe, particularly for Germany. Germany's very dependent on exports to China and Asia more generally. And if Asia's slowing, we're going to see that hit Europe. It does not hit the United States as hard as it hits Europe. India is insulated to some extent because, for better or for worse, it's a more closed economy. But President Trump has sort of turned his eye to India as well, maybe to tell the Chinese, I mean business.
Okay. Oh, yes, that warning has come home for sure. Well, I want to concentrate a little more on China itself. As you said, a lot of the excesses of the 2009 fiscal stimulus, the extent of about 8–9% of GDP, is still residing in the form of bad loans to local governments, local companies. Do you see any of that coming home to roost? Can we get an accident out of China?
Well, I don't know that we'll have a Western-style accident because the Chinese government will very quickly socialize any problems. But where they're really running into obstacles is a lot of the stimulus went into housing. And goodness knows they needed housing. But today, China has the same square meters per person as Germany or France, and it's a much poorer country. How much further can they do that? A very large segment of the population works in housing, a lot of the investments in housing. They can't keep that up. I don't think their stimulus is going to work in the same way that it did 10 years ago.
Okay. Well, 2 years ago, I think late 2015, one of the big problems the world was worried about was a rapidly depreciating yuan. Can that be another specter that the world should worry about?
Well, it's possible. Obviously, it's mixed in with the trade negotiations. I think China, may decouple more from the dollar at some point. If its economy is slowing, it probably should do that. And that would be disruptive, but not as disruptive as China's economy slowing dramatically. I think that's the much bigger issue than the exchange rate. After all, a lot of China's trade is priced in dollars.
What's your base case? Does China slow gently and, the world will not feel any tremors? Or should we be prepared for some kind of accidents out of China? What does 2019 look like?
I think it will slow significantly, not in a financial crisis form, but significantly. But the real thing is the world's going to reevaluate China going forward. They're going to reevaluate their business models. So yes, I think this is a very important year as a turning point in China's role in the world economy. Europe's going to feel it a lot. The Asian countries that are very dependent on China are going to feel it a lot. China's been a big engine of world growth. I think those days are over where it's just accounting for half of world growth. We're not going to see that for many, many years again. All
right, Professor Rogoff, we are out of time. Thank you very much indeed for joining us and giving us your view of what we heard from Li Keqiang, 6 to 6.5, something that makes Professor Rogoff laugh. But the bigger takeaway from what he's saying is that China is not going to be that big engine of growth. The negative would be that Indian exports also would suffer. But the positive for India could be that we're not going to see any spurt in crude or in any commodity prices. We'll have to wait and see whether the positives outweigh the negatives. We take a break on that note. We are coming back with Jahangir Aziz, the chief economist on emerging markets from JP Morgan. Stay with us. We are back in a jiffy.